TheoTrade. This is Don Kaufman. December 8th, 2021. You've got 20 minutes to go to the cash close here on this Wednesday afternoon. The S&Ps, well, some of that wicked rip your face off rally just kind of dying out a little bit today. It's a very inside trading session, or what I have tendency to term an absolute unequivocal slop fest of a market day. Listen, we're going to start in probably the most likely of all areas, the SPX. And the reason that we're actually looking at the SPX specifically is because we have tagged the upper edge of the expected move. So this line across your screen, this is what we talk about on every weekend update. We're always talking about this in the Wednesday night video as well. That upper edge of the expected move, I mean, literally we are what? A point or two off of it at this point in time. And what's just absolutely shocking is in a marketplace where you have, I mean, a $4,700, index product, we tag the upper edge of the expected move and we ride it throughout the course of the day. And that's actually why I call this a little bit of a slop fest, because the moment we actually hit this is where risk kind of dies out. We just kind of chop around the edge and the upper edge, if you will, of that expected move. Nevertheless, you got to be asking yourself, I don't care whether you're a buy the dipper, whether you're a bear, okay, whoever you are in this business, a long-term investor, okay, just a short getting squeezed right now, okay, everybody's looking for the answer. Will that volatility that we saw come raging back? We're going to look at that in this evening's video. So once again, a little bit of a broader take on the expected move. In this particular circumstance, we're actually looking right now, okay, at the daily chart. The expected move for the week, and I'll remind everybody exactly what it was from the weekend video, was plus or minus $157. And we're smack on right now. However, that being said, got to be cautious at this point. And the caution comes by means of the fact of, all right, you had two trading sessions. You shot directly to the upside, 157 points. We've done nothing today. I think you have to anticipate, though, some more price action coming into Thursday and Friday. The only question is, what will be the catalyst? Again, coronavirus, of course, was and the new variant was blamed for some of the sell side activity, but of course that also coincided with the Fed, okay, and the testimony that ultimately said we're not transitory anymore, okay. The other thing you have to kind of rationalize is, yeah, we're going to have an FOMC meeting next week, and you can already see substantial positioning in the bond market. The bonds just got downright volatile. So one of the things I think that's being missed over here in the, to answer this question, is volatility going to come raging back? People, the volatility right now turned and shift, okay, into the bond market. And you're actually seeing huge volatility as well starting to hit the dollar. Okay, it's not exactly a happy-go-lucky sign to see the sell-side activity in the bond market, because it would only take another 2, maybe 3 bond points of sell-side activity, okay, to start to spark fear of rising rates all of a sudden. And again, it was like, oh, rates are going to rise. Listen, there's some sell-side activity inside of the bond market right now. Take a look at the TNX. Just over the last 3 trading sessions, people, that is more than a bounce. I mean, we took off from 1.35% and we are, okay, lighting up the screen to 1.5% on the 10-year. Nevertheless, okay, some more sell-side activity inside of the bonds could actually spill over expressly into the Nasdaq, and we could actually see sell-side activity in the Nasdaq. The other aspect that I think that's really worth mentioning on this case is, again, there's positioning that's going to be going on before the FOMC, and that's what I believe we're already starting to see inside of the bond product, right? The irony of that is, okay, it is not helping the financials. Big selling today inside of the bonds, right? We have almost no movement whatsoever inside of the notes. Nevertheless, the financials are not reacting like you would anticipate them to react. And it's, again, a little bit of a warning shot being fired across the bow. You're like, wait a second, how come the financials, they should absolutely love this? A lot of it has to do with the fact that the financials, they're just hitting the upper edge of the expected move, just like the S&Ps. Okay, there's a ton of different products, by the way, right now, just resonating right on the upper edge of the expected move, and that's stalling them out. Okay, nevertheless, okay, markets, even though we've seen a 157-point move to the upside inside of 2 days, they are highly guarded. Yes, we've seen volatility come down substantially. Okay. But is it screaming the all clear sign over here? Absolutely not. Vol futures have dropped, though, back into a fairly significant contango, right? The VIX, the VIX, though, is still what? At the 20 handle. Well, before all of this sell side activity occurred, okay, we were already on a little bit of a bid to the VIX, but again, perspective here, your stones throw off an all-time high in the marketplace. But again, everywhere you look, okay, is kind of a highly guarded stance. So at this point in time, I'm not ready to call raging volatility, but I think you have to anticipate that the marketplace is still, again, extraordinarily guarded. I'm going to give you one other very diabolical aspect over here before I talk a bit more about volatility. And the diabolical side of the marketplace is simply this, and this has been just strictly my opinion for a considerable period of time, okay? And ultimately it has everything to do with the fact that people are getting roped heavier and heavier and heavier into the idea, okay, of the buy the dip. And everybody's just chanting over there, buy the dip, buy the dip. Obviously, the last 2 days, okay, it has worked, and it's worked effectively until it does not. My only caution to you on this particular front, okay, if you're a dip buyer, if you're a believer that nothing is going to stop this marketplace, okay, it's fine. However, define your risk. And that's something I've reiterated, each and every time I've come in here since this volatility kind of sparked, because when you start to look at this, specifically on a much larger time frame, like we'll pull up 3-year daily, okay, this just doesn't feel, okay, again, like run-of-the-mill volatility. For the first time, though, you also have to consider the Fed. They don't have your back anymore. I'm not sitting here preaching about, buy the dip. All I'm simply saying is that you need to think about defining your risk if you're trying to get directional around any of these dips, simply because we may hear some pretty rough news next week regarding, of course, the FOMC not necessarily having the marketplaces back. I mean, realistically, okay, can you remember the last time that the FOMC, okay, has made a statement that did not have the marketplaces back? All right. And I'm going to give you a very, very specific example of this. You would have to go back, okay, into December of 2018, where we absolutely tanked, to 240 on the SPY before the Fed literally changed their stance between Christmas and New Year's. This was actually Christmas Eve, one of the big sell-offs. Of course, we just had a big sell-off on Black Friday. Nevertheless, okay, the marketplace, this is awe-inspiring, this type of a rally, and this is not like a big bearish connotation, but for the first time, okay, we are going to hear how the Fed doesn't necessarily have our back. And again, the Fed, they have some decisions to make. They want full employment, or do they want to fight inflation? They're both aspects that I don't think you can win with either one of them, but inflation is going to have some very, very serious implications. Nevertheless, back to the volatility discussion, when I say things that are highly guarded, okay, you still have stocks like NVIDIA. NVIDIA hasn't necessarily broken back out to the upside, just holding here, down some 2% today, but it's been a drag to the Nasdaq. Tesla's got a little bit of a bid back under it, but again, still kind of, waffling around the 1,000 level, and very likely to still see some considerable volatility in the near future. Both Tesla and NVIDIA, one of the things that I think that's, worth bringing up over here under volatility studies and implied volatility, okay, neither Tesla nor Nvidia has really seen a volatility crush like the remainder of the marketplace. And again, this is a bit of a cautionary tale because what sent the Nasdaq into a heavy tailspin were these two particular underlyings. Again, watch volatility in the days to come. A few last aspects over here. Of course, we're still seeing a VVIX that is absolutely flying high. Okay, if you're unfamiliar with the VVIX, the volatility of the volatility index, okay, it hasn't crossed back under 110, so it's still, again, come down incredibly. I mean, we hit almost a 170 VVIX. We've come down to 115. Nevertheless, it's still fairly guarded stance. Skew is actually sitting still at the 151, 152 handle. Everywhere you look, sure, trades back to the upside. Sure, we're a stone's throw, literally a stone's throw off the all-time high of a marketplace after everything we've been through over the last couple of days, okay? At this point, again, there's so many traders that are just looking at this and saying the market is impervious to everything. Of course, then you start to think about inflation and the fact that the Fed doesn't have our back anymore, okay? We're looking a fairly guarded stance in a number of products out there. Keep your head in the game because it's very likely between now and even Christmas that we will see quite a bit of volatility and it will come raging back. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.